Hello everybody. Firstly, I'd just like to welcome you to this webinar where we'll be talking about crude oil and the trading opportunities on crude. My name is Sasha and I'm a financial analyst from the research department at ForeTrade. I'm delighted to have you with us. If you have any questions, please call us and ask to speak to a senior account manager who will be happy to help. And before I go any further, please take a moment to read our risk warning and disclaimer. I'm sure you know that although gains can be made trading CFDs, losses can be incurred too, and you need to be aware of this. And now let me explain what a market opportunity is if you don't know. A market opportunity is a one-page briefing containing market analysis, and our goal is to provide you with a simple-to-understand opportunity to trade in the markets. We will select an instrument such as gold or a currency pair and tell you our very best estimate on its price direction so that you can trade on it if you want to. Market opportunities are produced by the research department on a daily basis according to market conditions. A market opportunity consists of fundamental analysis, geopolitical events, and technical analysis that includes a pivot point and support and resistance levels. It's important to understand it's your decision whether you want to trade on market opportunities or not. So here is an example of a market opportunity. You can see some fundamental analysis on what's going on with crude oil. You can see, for example, how Saudi Arabia says here it will make up the shortfall of oil in the market due to Iranian sanctions. This could apply downward pressure to crude prices. As you could see, this is a downtrend opportunity over a weekly period. When using a market opportunity, it's vital to look at the pivot point on which the calculations are based. In this instance, if the price reaches the pivot point, the current price that you can see in the center of the screen here, this shows the right moment in our estimation for opening a trading position if you had decided to trade on this market opportunity when it was active. You can see below the trend direction and the time period. It's also important that you know how to use the stop loss and take profit options. You have support and resistance levels further along. At these points you can put a stop loss and take profit, and further down you have calculations on the other side of the screen. If you close the position using take profit, you can expect these kinds of profits at the support levels in green. If the price is going against you, you can potentially have a loss of this amount at these resistance levels in red. Finally, profit and loss calculations are based on a one-lot trading volume. Before I let you know what's going on with crude, let's cover some basics you need to understand to trade crude successfully. Demand and supply. There are two parts to understanding crude oil which dictate crude oil prices. The supply of oil in markets, i.e. if oil production is high and there is plenty of crude available, this drives prices down. If there isn't enough oil in the markets and oil production is low, then the price of crude oil will tend to go up. On the other hand, there is demand. If, for example, global growth is high and countries are doing well, demand for crude oil will increase. An increase in demand tends to push prices up. But if there is a recession, for example, demand can decrease for crude and prices are more likely to decrease. The price of crude you trade on reacts to both demand and supply. If you are counting on crude prices rising, the best scenario for you is that demand is high and supply is low. But if you want crude prices to go down, you will be hoping that oil supply will go up and demand for oil will decrease. The most important indicators of demand and supply are the weekly figures released by the American Petroleum Institute, the Energy Information Administration, and Baker Hughes oil rig count released on Tuesday, Wednesday, and Friday, respectively. Geopolitics. Geopolitical factors are other huge price drivers for crude oil. The sanctions imposed on Iran last year was a great example. When an oil-producing country like Iran has sanctions placed on it, crude prices will tend to increase, since the supply of oil in the markets will be reduced. Wars in oil-producing countries can also drive crude oil prices up, since any potential disruption to oil supplies affects the markets. Even statements from senior officials from oil-producing countries impact prices. One major example of geopolitics that's currently affecting crude directly is the political and economic crisis in Venezuela. The country is a major oil producer and exporter and has been unable to put its oil on the market. Traders know it's important to understand the role of the Organization of Petroleum Exporting Countries, OPEC, which includes many of the largest oil producers in the world, including Saudi Arabia, OPEC's key player. The organization generates some 44% of all world oil production. It agrees jointly whether to increase the production of oil, which should influence prices down, or to restrict oil production, which should help push prices up. Since 2016, the organization has successfully invited Russia, the second highest producer of crude, to join these agreements, even if Russia isn't formally part of OPEC. OPEC and Russia previously had an agreement to restrict the supply of crude oil. At the last meeting in December, in the face of declining oil prices, OPEC decided that it would further cut production by 1.2 million barrels per day, which eventually caused a stabilization and a slight bounce back in crude oil prices. So, Russia, the world's number 2 producer, and OPEC have considerable power to influence crude oil prices. Russia has not complied with this OPEC agreement and has not cut its oil production by as much as the country originally committed to. With soaring US production and high Russian production, oil prices have not climbed as much as was hoped by oil bulls until recently. Saudi Arabia and other OPEC countries, however, have managed to prop up prices by decreasing their own production beyond its initial commitment. Saudi Arabia has been trying to work behind the scenes with other OPEC members to get Russia to agree to a more formal deal to be signed between Russia and OPEC in order to more effectively control production. Russia has resisted these moves so far. It's clear to most analysts that Russia doesn't mind lower oil prices as much as OPEC, which would prefer that crude prices rise. The next OPEC meeting is on June the 25th, when the current production deal will be discussed. But let's talk about price movers for a moment before we look at how crude's price direction went recently. So, President Donald Trump recently provided a perfect example of how even a single person's statement can move the market. Let's take a look at what happened recently on February the 25th. President Trump took to Twitter to say, "Oil prices getting too high, OPEC, please relax. The world cannot take a price hike." The result was an immediate drop in crude oil prices. You can see how crude finished the trading day down around 3.5% as a result. But what's clear here is that this drop, apart from a slight pullback, went on for hours after Trump's tweet. 2 days later, crude prices had recovered almost to previous levels, as you can see in green. The point to remember is that oil traders that moved even an hour after Trump made the statement could still take advantage by selling or shorting crude. Or they could anticipate a bounce back over the following days and buy crude cheaply. There is no guarantee that the markets will behave like this all the time, but some investors made big gains from Trump's tweet. In fact, out of 9 times Trump has made statements on OPEC, 6 of them has resulted in the price of oil prices dropping, and in many cases going sharply down. You can see most of them here and their impact on crude. So let's take a look at the last volatile 6 months. On this chart, we can see how crude hit a 3-year high in October 2018 of $75.84, before crashing to its lowest level of $42.71 since June 2017, and that was on December the 24th. This was a staggering fall of 43%. Oil markets were oversupplied and exemptions were given to a number of countries, enabling them to import Iranian oil, which was subjected to US sanctions. So let's take a look at crude oil prices since the beginning of the year. Since then, crude has jumped above an astonishing 35%, posting its best January performance on record and continuing to trade higher, breaking that 3-month losing streak that saw crude lose nearly half its value. So, what are the reasons for the recent uptrend in crude prices? Oil has been boosted by the OPEC-led production cuts I mentioned, aimed at draining oversupply, and US sanctions on Venezuela, which threaten to disrupt global trade flows and have bolstered prices. Despite earlier fears of an oil glut and an economic slowdown, investors felt that oil prices were priced too cheaply and bounced back to a 3-month high. The geopolitical situation in Libya, with a military conflict on the ground, has also helped push prices higher recently, as warlords have voted to use access to oil as a means of political pressure. Any disruption to oil supplies and conflict is supportive for crude. Markets were also supported by strong economic data in the US, which reassured investors that the slowdown won't affect the US this year, even if it is impacting China. This is important since any slowdown leads to a decline in demand for crude oil, pushing prices downwards. Finally, progress in US and China trade talks have also pushed prices higher. The graph shows us that crude prices have indeed been volatile over the past 6 months, but OPEC and some analysts at least believe in the near future that prices won't change in one direction quite as quickly. So most recently, oil has been pressured after comments from Russia raised concerns that the OPEC-led supply cutting pact may not be renewed. Russia and OPEC may decide to boost output to fight for market share with the United States, Russian Finance Minister Anton Siluanov stated. The Organization of the Petroleum Exporting Countries and other producers, including Russia, that's what we also call OPEC+, have been cutting output since January the 1st. They will decide at the full OPEC meeting on June the 25th to the 26th whether to continue with this arrangement. But most recently, crude has been boosted by economic data from China, which suggests that the slowdown in China may have stopped. Alongside this, statistics from China, the world's second largest user of crude oil, suggest that demand for crude oil is still growing. Of course, we at ForTrade will be following any developments that affect the markets very closely, so please do get in touch with the Senior Account Manager if you have any questions or want to take advantage of the trading opportunities that crude oil presents. Until next time, goodbye, and please join us at ForTrade again soon.